In this video, we're diving into when it makes sense to refinance your car loan and why waiting too long can cost you. What's going on, everyone? My name is Eric Hunsaker, and on this channel, we cut through the fluff to help you make smarter money moves. Now, if you're on the fence about refinancing your car, then this video will help you decide whether now is the right time. How car loan amortization works. Now, before we talk about timing, it's important to understand how car loans are structured. Most auto loans are amortized, meaning your monthly payment covers both interest and principal, but not in equal proportions. So in the early months, a large portion goes towards interest. Over time, more of your payment goes toward principal. This schedule is front-loaded, so the bulk of the interest is paid in the first half of the loan. Now, why does this matter? Because when you refinance, you effectively reset the amortization clock. You may lower your monthly payment or interest rate, but you're also extending the term and shifting more money toward interest in the early months of the new loan. Now, that's why timing your refinance is crucial. You want to maximize interest savings rather than start the clock over when most of the interest has already been paid. When it's too soon to refinance. Now, you might be eager to refinance right after driving your new car off the lot, especially if you didn't get the best rate to begin with. But there are a couple of reasons why refinancing immediately isn't practical. Wait until the title is in your name. When you buy a car, the title is transferred to you and your lender. The process can take 60 to 90 days depending on your state. Until your name appears on the title, most lenders won't process a refinance because they need to see proof of ownership and confirm that there are no liens or outstanding issues. Give your credit time to recover. Car purchases often involve a hard inquiry, which temporarily lowers your credit score. Lenders also like to see a few months of on-time payments before they're comfortable offering a new loan. If you apply too soon, you might not qualify for the best rate. Generally, waiting at least 6 months allows your credit to recover and establishes a payment history. Build a track record of on-time payments. Many lenders require 6 to 12 months of on-time payments before they'll consider refinancing. This history proves that you're a reliable borrower. If you miss a payment during this time, it could set you back months and cost you higher interest rates or outright denial. Signs it's the right time to refinance. Now that you know when not to refinance, let's look at signals that it is the right time. Interest rates have dropped. The most obvious sign is a drop in market interest rates compared to when you took out your loan. Rates fluctuate due to economic conditions, Federal Reserve policy, and lender competition. If average auto loan rates have fallen by a percentage point or more, refinancing can save you money. Even half a percentage point can make a difference on larger loans. Your credit score has improved. Maybe you had average or fair credit when you bought your car, and your lender charged you a higher rate. If you've paid down debt, reduced your credit utilization, or removed negative marks from your credit reports, your score may have climbed significantly. A higher credit score can qualify you for a lower rate, especially if you've moved from subprime to prime or super prime credit categories. Your current loan rate is high. Even if market rates haven't dropped dramatically, your existing rate might be much higher than what's currently available. For instance, if you're paying 8% interest and comparable borrowers today are paying around 6%, refinancing could still make sense. Use online tools or call lenders to see what rates are available for your credit score. You have several years left on the loan. Timing also depends on how much time is left on your loan. Refinancing is most impactful when you have at least 2 years or more remaining. This gives you enough time to benefit from lower interest over the life of the loan. If you're already halfway through a 3-year loan, there might not be enough interest left to justify refinancing costs. You want to shorter your loan term. So refinancing isn't always about lowering the monthly payment. If rates have dropped and your income has increased, you might refinance into a shorter term with a similar or slightly higher monthly payment. Shortening a 60-month loan to 36 months at a lower rate can save you thousands in interest and get you debt-free sooner. You need to remove or add a cosigner. Life changes happen. Maybe your original loan had a cosigner and you're ready to release them. Or you're adding a spouse. Refinancing is the opportunity to remove or add co-borrowers without changing lenders. Lenders typically require your credit to be strong enough on its own or the new co-borrower's credit to be considered. Your vehicle has maintained value. If your car's value remains higher than or close to your loan balance, refinancing is easier. Lenders prefer collateral that retains value. Vehicles that depreciate slowly, like some trucks and SUVs, may be good candidates for refinancing after a couple of years. Now, on the other hand, if your car's value has plummeted, lenders may not approve a new loan or may offer unfavorable terms. When refinancing might not be worth it. Now, just as there are signs that it's time to refinance, there are situations where it's better to stick with your current loan. You're close to paying off the loan. If you only have 6 months or a year left on your loan, then you're probably already paying mostly principal. Refinancing resets the amortization schedule and may extend the term, resulting in more interest over time. At this stage, it's usually best to ride out the remaining payments or pay off the loan early if you have the funds. Your car is older or high mileage. Most lenders won't refinance vehicles that are more than 8 to 10 years old or have over 100,000 miles. Even if they do, you might be offered a high interest rate because the car is near the end of its useful life. In this scenario, refinancing doesn't make financial sense. You owe more than the car is worth. Being underwater complicates refinancing. Lenders review negative equity as risky because the collateral, your car, won't cover the loan if you default. Some lenders will roll the difference into the new loan, but that increases your debt and may trap you in an upside down situation longer. It's usually better to focus on paying down the loan before refinancing. Market rates haven't improved. If market rates haven't dropped or have risen since you took out your loan, refinancing won't lower your costs. So keep an eye on rate trends, but don't rush into a refinance if the prevailing rates aren't favorable. You may be better off waiting for a rate drop or focusing on other financial goals. There are high fees or prepayment penalties. Refinancing isn't free. New loans may come with origination fees, application fees, or administrative charges. Your current loan could have a prepayment penalty for paying it off early. If these costs wipe out any interest savings, refinancing makes no sense. Always do the math before signing on the dotted line. You plan to sell or trade the car soon. If you intend to sell your vehicle or trade it in within a year or two, then refinancing might not be worthwhile. The effort and fees associated with refinancing may not pay off in such a short time. In that case, keep your current loan until you sell or pay it off. Steps to determine the right timing. Figuring out when to refinance isn't as simple as looking at a calendar. So follow these steps to make an informed decision. Evaluate your current loan. Know your interest rate, remaining balance, and term. Check if your loan has a prepayment penalty. Check your credit score. Pull your credit reports and scores. Work on improving your credit if that's marginal. Address any errors. Watch interest rate trends. Keep an eye on average auto loan rates. Use resources like bank rate indexes or local credit union postings. Rates fluctuate, and a small window can make a big difference. Assess your car's value. Use tools like Kelley Blue Book or Edmunds to estimate your car's value compared to your loan balance. If you have positive equity, you're in a stronger position. Estimate savings with calculators. Use online refinance calculators to plug in potential rates and terms. Compare total costs of your current loan versus potential new loans. Get multiple quotes. Once you decide the timing is right, then obtain quotes from several lenders. Banks, credit unions, and online lenders. Ask about fees and terms. Consider the term. Decide whether you want to extend, maintain, or shorten the term. Extending can lower payments but might cost more overall. Shortening can increase payments but save on interest. Plan around life events. Consider upcoming expenses, job changes, or moving plans. Refinancing requires a hard credit inquiry and time to process, so ensure that it aligns with your broader financial picture. Finalize when it makes sense. If the numbers work and you're comfortable with the lender and terms, proceed. If not, wait and revisit later. So refinancing your car can be a smart move, but timing is everything. Wait until the title is in your name, your credit has time to recover, and you have a track record of on-time payments. Then, watch for drops in interest rates and improvements in your credit score. Make sure you have enough time left on the loan to benefit from a lower rate. Avoid refinancing when you're close to payoff, underwater on your vehicle, or facing high fees that eat up the savings. By understanding the mechanics of car loan amortization and following a methodical process, evaluating your current loan, tracking interest rate trends, checking your credit, assessing your car's value, and shopping around, you can refinance at the right time and save money. Don't wait so long that the benefits disappear, but don't jump so quickly that you hurt your credit or face administrative delays. With careful planning, you can find that sweet spot and put more money back in your pocket. So if you want to try out any of the tools or resources that we recommend, you'll find links for them down in the description below. Some of these are affiliate links, which means we earn a small commission when you use them at no extra cost to you. And this really helps support the channel and lets us keep making simple, beginner-friendly videos to help you take control of your money. So if you end up using them, we thank you so much in advance. And if this video helped you out, don't forget to like, subscribe, and hit that notification bell so you never miss another video. Here on Your Money Friend, we talk about saving, banking, investing basics, and all the little money decisions that make life easier without all the confusing jargon. So thank you for watching, and we'll see you in the next video.